Okay, here's a question. Is your credit score a work of art or maybe a work of fiction? Because the market just handed a pretty failing grade to one major company dealing in those very numbers. Welcome to D-Risk, a podcast where we provide a no-nonsense analysis of stocks. Today we're doing a deep dive into Equifax, that's ticker EFX. We're using our research captured this morning, October 3rd, 2025, right around 8:23 a.m. Eastern Time.
And the backdrop right now is definitely giving people whiplash. Futures are, trying to edge positive. But really, the main feeling is just anxiety. We've got this threat of a U.S. government shutdown looming. The Treasury Secretary even warned it could slice billions off GDP every week it happens.
Right, billions. And why does that matter specifically for Equifax?
Well, look, if the jobs data later this week comes in weak, or if we hear hawkish talk from the Fed today, what happens? Credit issuance tends to slow down. And Equifax, well, they make money on those transactions, right? So anything that hurts loan volume, mortgage volume, it just amplifies their risk, makes them really vulnerable if some of their shoe drops.
And speaking of shoes dropping, that nervous backdrop just perfectly set the stage for Equifax's own sort of company-specific shock. The catalyst for the stock tumbling wasn't like bad earnings or anything. It was Fair Isaac FICO.
FICO.
They launched this program, and it sounds like it essentially lets mortgage lenders cut Equifax and the other bureaus right out of the loop for verification.
That's pretty much it. FICO is leveraging maybe alternative data sources or allowing lenders to submit info directly, basically bypassing the big three bureaus for, certain types of transactions.
And the market reaction.
Oh, it was violent. The stock just cratered. But what's really fascinating, I think, is the divergence this created in how people value the company. You look at Wall Street analysts, they seem to be largely shrugging it off. Almost 60% still have buy ratings, 0 sells. They must be banking on Equifax's proprietary data holding up.
Okay, so the analysts are bullish.
But then you look at the valuation models. One model, based on current DEP earnings, suggests EFX could be worth over $250 a share. But another model, this one based on actual free cash flow, the cash left over for shareholders, pegs its value at, well, a frankly shocking $84.
Hold on, $84. You're saying one model suggests it's trading at what, nearly 3 times its actual value?
That's the implication. It's a massive, massive divergence.
So, do we trust that $84 number? Or is that model just, built on super pessimistic assumptions about the future?
Well, when you see free cash flow and GAAP earnings split apart that dramatically, it's often a red flag. It suggests maybe those accounting earnings aren't actually turning into real spendable cash. Could be high capital spending, could be big debt payments eating it up. And this FICO threat, it hits right at the heart of what Equifax needs most: strong future cash generation. So the big question is still, was this FICO news a genuine body blow to long-term cash, or is the market just having a knee-jerk reaction?
Okay, that's the sort of institutional conflict. But what about the retail side? The options market often tells a different story, right? What are the speculators betting on?
Yeah, interestingly, the crowd seems to be betting this is overdone. The put-to-call ratio in the options market, it's sitting around 0.67. Generally, that's seen as bullish. It means more call options, bets the price goes up, are being traded than put options, bets it goes down. So speculative money thinks the sell-off was too aggressive.
Okay, bullish options. What about short sellers?
Pretty moderate, actually. Short interest is only about 3% of the float. So not huge conviction from the short side either. The market seems to have drawn lines in the sand, around $240 for support, $280 as resistance overhead.
But then you look at the price chart itself. And wow, it tells a really brutal story, doesn't it?
Oh, absolutely.
We're looking at a technical picture that has just completely fallen off a cliff. Key indicators, flipped negative hard. And the crucial thing here is the volume, the conviction. This wasn't just like quiet selling. The collapse happened on massive volume. That tells you big money was heading for the exits. That chart is just shattered.
It is. That said, there's a little nuance here. The drop was so fast, so violent, that some of the momentum gauges are actually flashing oversold now.
Oh, okay.
Which means, the downward pressure might be getting exhausted, at least temporarily. It could potentially set things up for a short-term bounce, maybe a relief rally before the sellers decide to reload. Something to watch.
Right. Okay, so let's put it all together. We've got this broken chart, somewhat hopeful sentiment in options, and this really fundamental risk from FICO. What's the strategic verdict from our research?
Our call right now for Equifax is neutral, but definitely with a bearish bias.
Okay, leaning bearish. Why?
Well, that bearish lean comes because you have this genuine fundamental threat to the FICO news, and it's been confirmed pretty catastrophically by the technical breakdown on the chart. So yeah, while a bounce is possible because it's oversold, the overall structure suggests the sellers are still in control for the time being.
Got it. So what does this all mean for you, the listener, the investor? The key levels seem pretty clear.
Exactly. The next battleground is right there. For the bulls, they need to get back above that breakdown point around $240. That's the big psychological level. If they reclaim that, it might invalidate the immediate bearish case.
And for the bears?
They're likely looking at the recent low, down around $224. If the price breaks below that level, it probably signals the next leg down is starting.
So the big question hangs there. Is Equifax's own financial profile in need of some serious credit repair?
It really feels like it. The chart is screaming, yes, you've got those scary cash flow models backing it up. But then, the options crowd is betting it's maybe just a flesh wound. It's a classic fight, isn't it? Broken chart versus hopeful sentiment. What's your main takeaway?
It's definitely a tense situation. That's all for this deep dive. Remember, this podcast is for informational purposes only and isn't financial advice. Do your own research or consult with qualified financial advisors before making any investments. Thanks for tuning in. Catch you in the next episode.